Hello again. Doing some financially fit Fridays. I welcome you. My esteemed colleague is not going to join us today. She took her oldest son to his first year of college at the University of Miami of Ohio. So, congratulations to Jonathan and his endeavor at the new college. But what I was going to talk about today is some financial planning or retirement numbers. Questions that I always get when we are working with people in the 401k space, especially as we're out doing seminars and presentations, is how much can I contribute? Well, the contribution limit does change every year. It's based on a few different factors, CPI and some other things. But for the most part, the IRS comes out with those figures generally around October. We should know the numbers for the next year when it comes to 401ks, IRAs, simple IRAs, SEP IRAs, different things along the retirement side that we get notifications for. But for this year, you have some time to impact your contribution limits. This year, if you're under 50, you can contribute up to 50 or 19,000. I'm sorry, under 50, 19,000. If you're over 50, you can do an additional 6,000, which would be 25,000 for the 2019 year. So if you do a pre-tax 401k contribution, every dollar that you contribute helps lower your overall income for that tax season. So people say, I generally can't afford it. I mean, I've done examples where if you did $50 a month into your 401k, it's actually like maybe $42 a month coming out of your paycheck, or maybe even a little less, depending on what your spouse is doing, if you're married, filing jointly, or if you're single, all the different tax rules. But you generally will see a savings when you're doing your standard contribution to your 401k. On the IRA side, you can contribute $6,000 a year. If you're over 50, you can do an extra $1,000. So a total of $7,000 if you're over 50 for that current tax year. The thing about an IRA is that you can actually contribute for a previous year up until April 15th of the next year. So if I wasn't sure how much I should contribute or how it'll affect my taxes, you can contribute for that previous year when you do your taxes. So tax time, I tell my accountant I want to put in $3,000 to my IRA. How much is that going to save me? I mean, a good rule of thumb of what I usually see is every $1,000 that you put in to your IRA, you save about $100, maybe $150 in taxes. But you're also saving for your retirement in that same sense. And each time you contribute every year, you're not taxed on capital gains, any interest income that you're receiving, or any dividends from your investments. So everything grows tax deferred. You're going to have to pay taxes at some point, no matter when you're taking out the money or not. And you're getting the upfront tax break as well. However, if you have an employer 401k, you're limited on what you can put into a traditional IRA. Your phase out is if your household income is over 103,000, you're phased out from contributing to your IRA. So there are different ways that you can catch up, but I'll explain that in a few minutes here. And the Roth is the same dollar limit. So you can do $6,000 in a Roth and $1,000 if you're over 50 as a catch up. A Roth is after-tax contributions. So I'm not getting any tax help today, but as the law stands now, when I'm 59 and a half and older, I get a tax break then because it's all tax-free income when I take it out at retirement. And there are some exclusions, like first-time home buyer, you can take out a Roth without any taxes, or penalty, I should say penalty, not taxes. You'll still have to pay taxes, but no penalty. Either account, whether it's traditional or a Roth, if you're under 59 and a half, there could be potentially a 10% penalty for taking money out of those accounts. The phase out for a Roth, though, is at 193,000. If you're married filing joint, is the annual number that if you make more than that household wise, you cannot contribute to a Roth. But like I said previously, there are some exemption or some ways to get around those numbers. One of the strategies is called a backdoor Roth. So that's contributing to a non-deductible IRA, and then in that same year converting it to a Roth IRA if you make over that 200,000 and you need to do that. That's one way that you can still contribute to a Roth, but you have to keep track of your non-deductible contributions and your conversions for your tax purposes. I think it's Form 8269 or something. Check with your accountant; they should know the answer to that. But being in a high income bracket, you're limited to where you can put money, how much you can save. This is a great way to put an additional, if you're over $57,000 away in a tax year, to grow tax deferred and have it tax free in retirement. The other thing about a Roth is it transfers to your heirs tax free. So if you never needed the money and it's sitting there growing tax deferred, and God forbid I pass away, my heirs would receive that money tax free as well. If they were to distribute it, if they're under 59.5, there's some tax issues there. But for the most part, they would be able to inherit that tax free. 401k, another part of the 401k, not only the high contribution limits for 401k, is the employer match. Some employers give a match, some don't. After 2008, some employers went back to a match, some did not. One of the things I see all the time in the 401k space is people not taking advantage of the full match. There's some different guidelines with however your company does a match, but if you don't do that full amount, you don't get the full match. So some plans are, let's say, 3% on the first 3% that you contribute, they'll match 100%, and then it's 50% on the next two. So it's a total of 4%, but you got to put in 5% to get that full 4%. So just some different things there that people don't realize that they need to contribute with the 401k. It's not a 401k, but another great way to contribute to retirement funds is through a health savings account. Yes, it's only used for medical expenses. It's only used for qualified medical costs. However, that money grows tax deferred and it's pre-taxed in the year that you contribute. So you can continue to put money in a health savings account. Just leave it there if you never needed it. Great. It could be used to pay your health premiums in retirement, whether it's your Medicare premiums, prescription drugs. The average person uses over $260,000 in retirement money for medical expenses when after 65, I think the study was from 65 to mortality, over $200,000 in medical expenses, where HSA, you can continue to grow your money tax deferred, take it out tax free, and it was pre-tax when you contributed. Triple tax advantage on a HSA. If your employer doesn't offer one, you can go to a local bank, start an HSA with the local bank, as long as you have a qualifying health insurance plan. So you generally need the high deductible health insurance plans to be able to do an HSA. So check with your employer, see if they have it, or if you know that you have a high deductible plan, look into doing an HSA. Pre-taxed, tax-free, tax deferred, triple tax advantage for an HSA. One of the other things that was recently passed was the modified employer plan. So if you work for an employer that doesn't offer a health plan or 401k plan, a 401k plan, have them contact us because we can talk to them about a low cost option. But the government decided that some employers weren't doing retirement plans because of the cost. Part of that is true. Part of it is some employers just don't have the time or the effort or the knowledge to seek out a low-cost retirement plan in which we can help them with those options. But, there are many multi-employer plans out there that people subscribe to. The biggest disadvantage that we see is the ability for the employer to market that plan to their employees. They don't because they didn't set it up, they don't have some of the answers to questions from employees. It was a good thing. It will certainly help spur retirement plans with small small employers. However, people should really look out both options, whether it's using a multiple employer plan or searching out themselves with what the actual costs are going to be. But certainly those are just a few things, and we can certainly help you out with any of those questions that you do have on the multi-employer plan or a 401k. Many people think because I have a retirement plan that it's a 401k plan. Well, there's a lot of other retirement plans out there. Like I said at the beginning, there's Simples, there's SEPs, different plans, a cash balance plan for a 401k, employer match is profit sharing, all those different lingos that are in there. Sometimes that lingo scares people, so they won't take advantage of a 401k plan. But certainly reach out to somebody, reach out to us, actually. Go to our website for different questions on retirement plans and why I should do them. And Social Security certainly won't be enough to live on. A lot of people these days don't have defined benefit plans or pensions that they need an extra income coming in retirement. If you could, we did an example one time, if you did a Roth, a 401k, and then at retirement you're collecting your Social Security, you can withdraw almost, now every tax situation is different, but you could take out almost $60,000 a year if you structured it correctly for tax-free income. $60,000 a year tax-free is a decent sum of money, but we can certainly help you with that. And our topic for next week, if you have any questions, will be on college savings. Because Ms. Abaya is not here today, we're going to skip that section. So we'll continue with college savings next week. We'll talk about 529s, the high cost of college, how you're going to pay for it. People say, well, I'm going to do a Roth, I'm going to do an IRA for my kids' college. And we'll touch on a lot of those subjects next week for our college savings webinar that we'll do quickly. But if you have any other topics in the meantime that you want us to research and get back to you or broadcast on, we're certainly open to any ideas going forward. And I thank you for your time, and visit our website at www.buffaloFirstLLC.com. You can always give us a call at 716-204-8369. And go Bills tonight in their preseason game against the Lions. Have a good one.